The problem with the fiat system, the problem with all debt systems is that they're exponential. They rely on compound interest, right? When your money is lent into existence, which that's the way our monetary system works, all money is debt, right? That means that your monetary system and your debt system will grow in a parabolic function forever until they break.
This week, we are live in the studio with special guest Peruvian Bull, talking about global financial markets. What are we talking about?
Global financial markets, Bitcoin, Triffin's dilemma, how the whole system works, essentially. If you're curious, definitely tune in today because it's going to be a great episode.
Stick around. All right, welcome to another episode of the Block Reward Podcast. We are in studio again this week. Excited to have a special guest in person, live in the flesh, Peruvian Bull.
Hey, how's it going? Thanks for having me, Scott. It's a pleasure.
Yeah, thanks for coming. This is tons of fun. We've just kind of like started doing these in-person episodes, and so excited to have you here.
Yeah, I'm excited to be here. This is such a cool studio you have already set up, like the orange couch, themed lighting. I can see the Bitcoin intentionality and everything already.
Yeah, that's right. So you were on the show, like it's been a little bit more than a year.
Yeah.
And I think on that episode, we were really talking about your book Dollar Endgame and sort of your broader sort of global currency thesis.
Yeah. The Japanese yen carry trade.
Yeah.
Yeah. How all that works to tie into, the Bitcoin macro thesis.
Yeah.
Because that's the key part to understand is, the way the global monetary system is heading, Bitcoin is, I think, going to play an increasingly important role in the way that international reserves and international settlement is actually done in the future.
So maybe for people who are interested, they can check out that episode, and
Sure.
we won't rehash the whole thing. But like, what is the most significant challenge you see faced by the global financial system?
Yeah.
And how does Bitcoin fit into it?
Sure. Perfect. I can start with what I would call like the most important part of understanding the global monetary system in general, which is Triffin's dilemma and the dollar, right? So we're all taught from, very early age, like Nixon broke the gold standard in August 1971 because all these countries were redeeming gold for their dollars holdings, but they don't really explain why. They don't explain, how this emerged. And Nixon's unraveling of the gold standard actually was predicted a full, over 10 years earlier, 11 years earlier in February 1960, when a Belgian economist named Robert Triffin came in front of Congress and testified that the global monetary system was going to break down. And the reason why was because he explained that, under Bretton Woods in the, midst of World War II and 1944, the 44 nations that convened there had agreed to peg all their currencies to the dollar, and the dollar was going to be pegged to gold at $35 an ounce, right? Now, when the dollar and when the US primarily is growing faster than the rest of the world, and when the rest of the world is in tatters and not really producing much economic activity, and all the industrial bases of Europe and Asia are gone, and Africa is not developed, and the Middle East is not developed, there's not really a problem, right? But once you have the rest of the world start to globalize and start to re-industrialize their domestic economy, you run into this problem where the dollar is now the global reserve currency. All these countries now need dollars in order to, fund trade, in order to hold those foreign exchange reserves, in order to borrow and lend, right, for financial markets, because the dollar market was already obviously much more developed and much more liquid than domestic, currency markets. And the problem is, who's going to supply those dollars, right? All these other countries have a need for a currency that they cannot print. So what happens is all these countries start trying to get dollars from the US. And so what the US has to choose is, this is the dilemma, this is Triffin's dilemma. The US has to choose whether or not to supply that demand. This global monetary system has created dollar demand, a massive amount of dollar demand. And as the system grows and continues to globalize throughout the 1950s and 60s, the pull on the dollar becomes stronger and stronger. That financial gravity becomes stronger and stronger. And if the dilemma comes whether or not the US chooses to supply that. So if the US says, we're going to supply that dollar demand, we're going to go and, give everyone else as many dollars as they need, well, then they're going to print more dollars than are justified by the reserve ratio, because they only have so much gold. And at $35 an ounce, that only implies so much dollars, right? So that's one side of the equation. If they do the other side of the equation, which is they choose not to fund that global demand, the global economy will essentially seize up. There'll be a deflationary like credit collapse, credit freeze, and that would cause a global depression. And so either of those outcomes are not great. And Triffin ironically thought that we were going to do the latter. We were going to go for deflationary collapse. They were just not going to print enough dollars and the system was going to freeze up and we're going to have like a global, almost like a 2008 financial crisis on a global scale in the 1960s or 70s. But we went the opposite direction. Throughout the 1960s, especially through Vietnam, we started printing enough dollars. We did the guns, Johnson's guns and butter program. And we flooded the world with enough dollars to sustain dollar liquidity and to let the global monetary system keep running. The issue was we issued over 3 times as many dollars as was justified by that reserve ratio, right? So the French, famously the prime minister, then Charles de Gaulle, did the calculus, realized that the US had issued too many dollars and starts redeeming their dollar holdings for gold. The rest of the European nations start to follow suit. And by 1971, half of the above ground gold reserves held by the US Treasury were gone from the US. And so that was causing this crisis. And so
it's like a run on the bank.
It was a run on the bank. And so that's where they cut the gold window. But the issue emerged, right, is, okay, now gold is no longer the global, the global anchor for the reserve currency. So what is? And for the 1970s, for the majority of the 1970s, nobody knew what that would be. But finally, obviously, towards the end of the 1970s, we get the petrodollar system. And then we also have Volcker coming in hot to save the system with hiking rates to 18% plus and keeping them there for years. Super high interest rates in the US obviously draws capital into the US and re-strengthens the dollar, because at the time, the dollar index had weakened to 70. And so it was like down 45, 50% from its height in World War II. So that was causing obviously strain on an inflation in the US. And so that is emblematic, right, of the problem of this system, of any reserve currency system, is there's always external demand for a currency that these other countries can't print. And so you as the reserve currency have to export your currency. And the other side of exporting currency in trade is goods, right? So if you become a net exporter of currency to the global system, you have to become a net importer of goods. And so what does that mean? You have to get rid of your manufacturing base. You have to put it overseas. And so that's why we've seen the US move over the last 50, 60 years. The US manufacturing base has been completely decimated. And it's been put in Asia. It's been put in Europe. It's been put in the Middle East and Africa, everywhere but the US. Because why? The US needs someone to send their dollars to so that those people can now take those dollars and lend them out or use them in trade and have them circulate around the global system. And so that's the quintessential issue that every reserve currency faces.
So you mentioned Volcker and the 18% interest rates in the 80s.
Yeah.
And this is something I think that is really also a very poorly understood issue around foreign currency markets. And it's the challenge that other countries have when the interest rate is higher in a currency that's more desirable. So if the US dollar has an interest rate that's higher than the Canadian dollar, what does that mean? We talked about this with Japan, but maybe just talk a little bit about that dynamic.
Sure. So there's a concept in international monetary economics called uncovered interest rate parity, UIP. And it basically states that two currencies with different interest rates will equalize that difference in the actual exchange rate, right? So again, you have the US dollar at 5% and let's say Canadian dollar at 3%. If people can earn a higher yield in what they view as a risk-free asset, which is government debt, they will export their capital from Canada into the US, and capital will flow into the dollar. And the nature of that will show up as a foreign currency trade, right? They'll sell Canadian dollars and buy USD. And so CAD USD will move to strengthen towards the USD, right? And so that means that, the dollar in general becomes stronger. There's more capital and liquidity available for dollar denominated assets, and there's less available for the Canadians. And so if the Canadians want to stop a drain on their capital, they have to raise interest rates to be equalized with the US, or even maybe higher, because again, people might view the US dollar as safer. And so they will demand a relatively lower interest rate than they would demand for Canada or for Japan. So like the actual equilibrium rate for a third world country, for example, if the US is at 5, might have to be 7, 8, 9 to draw capital back into that country because people view it as like a higher relative risk for the money. And the US is like the global risk-free asset, the US government bond.
And so we've arrived in this really interesting kind of post-2020 world outside of the US where, and Canada's such a great example, where we created so much money in debt in 21, 22, and 23 to cover pandemic spending. And now as a result, sort of governments are also at the mercy of this free market interest rate system that is sort of like pulverizing the servicing cost of the debt we've accumulated. And so there's this interesting dynamic of like what's happening in the US and how every other sort of G7, G20 country needs to think about how to survive in this continually evolving dynamic.
Exactly. It's difficult because, again, if you're Japan, if you're Canada, you have this problem of what's called the policy trilemma, or sometimes called the currency trilemma, which is there's a triangle and you can pick 2 of the 3 sides and the 3 corners. And the corners are monetary autonomy, fixed currency peg, and free capital, like free flow of capital. So you can have 2 of the 3. You can't have all 3. And they're mutually exclusive. So if you pick monetary autonomy and free flow of capital, that means you can't have a fixed currency peg. If you have a fixed currency peg and a monetary autonomy, you can't have free flow of capital. Because the problem again is, think of the interest rate problem. If you have monetary autonomy, if you're going to keep rates at 0 and the Fed's at 5, money's going to flow out of your system, and that currency peg that you say that you're going to hold is going to break. So you have to freeze the capital flow. You can't allow capital to move in and out of your country because it'll disrupt the currency peg. And the problem is that puts all these central banks in a conundrum where whenever the US has a crisis, whenever the US does something, everyone else kind of has to follow suit. So that's where this term in macro globally synchronized growth comes from. And I've been macro research for like 7 years now, and I've been writing professionally on it for 4 years. But that term, I never really understood it until I fully understood this trilemma. It's like, oh, okay, so all these currencies that want to maintain their peg to the US dollar or maintain a range, right? They don't want to see their currency depreciate 50% in a year. So that means whenever the US eases, they have to ease. Whenever the US tightens, they have to tighten. They have to kind of synchronize their monetary policy with the US. But that's problematic because if you're, Greece or whatever, and the US is tightening because of domestic inflation, and your debt load's too high, you can't tighten. Like, it's not a good idea for you to tighten. You kind of pull into doing whatever the US is doing, right? And Greece obviously doesn't have monetary autonomy because they're under the Eurozone, but that's just like an example. Like Japan is a better example where they wanted to keep rates at the 0 bound as long as possible. And all that did was cause their currency to blow out from 100 yen to the dollar to 150. And they spent hundreds of billions of dollars in their currency interventions to try to stop the eventual, blowout of their own domestic currency with the yen. So.
Yeah, and that's arguably happening here now too. So to come back to something you said a little bit earlier about Triffin's dilemma, and just to sort of pull this all together before we go to Bitcoin.
Sure.
US dollars, the US has to make an ongoing decision about supplying the rest of the world with the dollars that they need to keep the system running.
Yeah.
And as a result of that, those other countries accumulate huge stores of dollars.
Yeah.
So Japan, China, everyone has a net inflow of dollars to their domestic economy. And so maybe just talk a little bit about the problem that creates and where it goes.
Sure, absolutely. That's a great point. That's where we get into dollar milkshake theory by Brent Johnson, which I'm sure you've heard of. It's truly one of the best macro calls, I think, in the last decade, where Brent laid out like this is the exact feedback loop and problem of the way this global monetary system operates is as we export dollars, right? All these dollars, whether it's needed for petrodollars, whether it's needed for international reserves, whether it's needed for other types of commodity trade, whether it's needed for something called the Eurodollar market, which is essentially just synthetic dollar lending that happens abroad, offshore dollars. All of that draws dollars abroad. And then obviously, like if you're a central banker, if you're a corporate treasurer, if you're an investor and you have a couple $1 million in your account in, Hong Kong or whatever, you want to earn a yield on that. And an easy way to earn the yield is what do you invest in? You invest in US dollar denominated assets. So you open a brokerage account in the US and you park your cash in money market funds, in treasury bonds, or even in corporate equities, right? Or corporate debt. So you basically recycle those dollars back into the US. And so that creates this feedback loop where the more the US exports their manufacturing base and the more we export dollars, the more the dollars flow back into our financial markets and juice up our returns, right? So that artificially strengthens our market above other markets. And also, obviously, it's a headwind for other markets in that entrepreneurs who are creating value and who are earning and, getting surpluses in their business, making profits, they aren't recycling those profits back into their domestic economy. They're recycling it back to the US and exclusively financial instruments. Mm-hmm. And so stock markets race higher and higher and higher. And the issue comes when, if there's a global liquidity crisis, if there's a global deflationary crisis and everyone needs dollars, they'll sell the assets that they have on hand to raise that cash. And that means US equities, US bonds, US treasury bonds all fall in value very quickly. And we saw that happen in August of 2024 with the carry trade unwind for about a week. We had very severe selling across, the S&P 500, the NASDAQ, even Nikkei, even, Europe was affected. We saw this just this month with the Trump tariffs. That was an example of a short blowout of the carry trade. And again, you can look at USD JPY. Whenever USD JPY is falling very quickly, that means the yen strengthening. That's an example of the carry trade unwinding because they're covering their shorts, right? They're re-strengthening the yen because they're buying back yen to pay back their loans because suddenly they're getting liquidated on everything. So that creates this problem, right? This what I would call like a sort of Damocles. It's if foreigners own, we have a 60%, negative 60% net international investment position as the US, which means foreigners own $19 trillion more of US assets than we own of theirs. And if they need dollar liquidity, they're going to sell what they have on hand that will raise dollars the fastest, which is US government debt, US corporate debt, and US equities. Mm-hmm. So that creates this problem where the US could see like a very rapid stock market decline in short order if there's a global monetary crisis. And ironically, of course, this always leads to more debasement, right? A lot of people will say, well, the Federal Reserve has this dual mandate of inflation and unemployment. That's their main goal. That's their prerogative. That's their choice. That's what they're going to align all their decisions on. And I say, look, you're right. That's what they claim to do. And that's what they do most of the time. But whenever there's a crisis, whenever there's a 2008, whenever there's a not Archegos capital, but long-term capital management in the late 90s, whenever there's a crisis like that, they throw all the economic theory out the window and they just bail people out. Because why? The system is built on this fractional reserve backing that is inherently fragile. And if they let anyone blow up, everyone can blow up. And so they have to come in and rescue at any first sign of trouble. And so if there's a global carry trade unwind and we see global stock markets start to collapse and we see global bond markets, yields start to blow out, they're going to panic and they're going to have to do QE in very short order. Mm-hmm. And that just means obviously like more inflation, more dollar debasement, more debasement globally because all those dollars will flow out and add to the global liquidity stack.
So it feels like we're getting closer and closer to Bitcoin, which, I think where we're talking about next is like, maybe the implied certainty that money printing is a fixture. And I think there's like a really common broad misunderstanding when inflation is described as something that kind of could get worse, but then it gets better, tied to this target, mm-hmm. which
the 2% target.
Right. Mm-hmm. And ignores the reality that, like we could very well be in for another wave in the next year or 5 years or whatever of like, massive price increase, continued devaluation of every currency. And like maybe what are your thoughts on all that?
I think that's a great way to put it. One thing I wrote about, and this is, a lot of people like this piece, was financial gravity and Fed's dilemma. So again, in the 1910s, 1920s, when the Fed was first created, right? It was this idea of a lender of last resort. And so the Fed was only designed to bail out the banking system and provide liquidity and not, specifically not solvency. It was only liquidity to banks that were solvent that needed it. But obviously, as you create this tentacled monster, right? This creature from literally Jekyll Island, it grows and grows and grows and grows. Just like in this story of Mr. Hyde or Dr. Jekyll and Mr. Hyde. Like the monster, it's this doctor who's, taking this potion to, cure some issue, and he starts to become a monster. And as he does his transformations and becomes more violent, he becomes less and less able to control it and becomes the monster for longer and longer periods of time. And that's exactly what's happened with the modern Fed. They first are just lender of last resort, and then they are opening a credit window in the 1930s, and then they start to centralize control under the FOMC. So they create a centralized board where instead of having each Federal Reserve Bank set their own interest rate, which is the way the system worked prior to 1933, now all of them are governed by the Fed Board of Governors. So now all of them all the Fed banks that are fractionalized are now united and coordinating their monetary policy. And then in the 1970s, you get the dual mandate. And then in 2008, they get the ability to buy mortgage-backed securities wholesale, which they didn't have the ability to, right? And through each crisis, their influence and power and abilities grow. And they just use, legal loopholes to accomplish this, right? During 2008, they had to create special purpose vehicles, Megan Lane 1 and 2, to buy up all the toxic debt. Because on the surface, the Fed was banned legally from buying private entities. It wasn't supposed to outright buy the equity of banks. It wasn't supposed to outright buy, toxic credit default swaps. It was banned from that. And so what they did is the Fed created a separate legal entity and then injected it with capital and had that entity buy it. So they got around the legal restrictions of the time. And when the Fed, especially in 2008, when they came out with this massive liquidity wave, brought the balance sheet from 800 billion to, 2 trillion, then 3 trillion, eventually to 4 and a quarter or something, and then it obviously tapered down. Everyone was running around with their head cut off, claiming that this would cause hyperinflation. Right? If you talked to Peter Schiff at the time, if you listened to the gold broadcast in 2010, 2011, which I'm sure you remember, and I remember watching as a very young teenager, you saw this like hysteria develop, and everyone was certain. They're like, this amount of QE is going to cause a monetary collapse. And it didn't. Inflation stayed at 2 or 3%, right? Even if you use like shadow stats and the other statistics, okay, maybe it's 3.5. Like it was moderate. Like it was pretty mild for the rest of the decade until we got to 2020, 2021. And everyone was like kind of curious, like, why is this? Why was the Fed able to print this much money and not cause this amount of inflation? And the reason why is because what the Fed actually does is, they don't print money in the way that we think money printing actually works. What they do is they create settlement balances or bank reserves. And those bank reserves are swapped for assets on commercial bank balance sheets. And those bank reserves, you can think of it as cash that is like isolated to the banking system. It's ledger entries on a giant SQL ledger that the Fed maintains. And so when they're adding to that balance, they're creating new money that the banks and the brokers and hedge funds and pension funds can use to buy and trade and sell financial assets. But it's limited in the sense that it can't eat. There's not many ways for it to escape into the broad economy, into the M2 money supply, right? These are just reserves. This is M0. There's not many siphons for it to be released into the general public and be used to buy your, McDonald's burgers, to buy your Beanie Babies, to buy everything. The only outlets in general are anything that's highly securitized. So mortgage-backed securities cause housing inflation. Obviously, it circulates within the financial market. So an increase in bank reserves will, in general, raise stock prices very quickly. So stocks go up, bonds go up, whenever they do QE, even crypto, like all the speculative shit, all rises. But the main outlets obviously are these, things that are highly securitized like MBS, or whenever the government's running a deficit. Because again, the government has this ability through the TGA to issue bonds, right? So TGA is the Treasury General Account. So the Treasury issues a 30-year bond or a 20-year bond. And that bond goes out to market, and a bank can buy that with bank reserves, right? Or the Fed can buy, it's kind of like it's a convoluted process. The Fed can be doing QE, and if the Fed is doing QE and they are printing bank reserves and handing that to a commercial bank, and then the commercial bank is using those bank reserves to buy a bank from the Treasury, that bank reserve is getting transferred from the Fed ultimately to the Treasury. Now, the Treasury needs to spend this on real economy activities, right? They need money for entitlements. They need money for war. They need money for healthcare, social security, for infrastructure, whatever it is. And that means that these bank reserves now have to become fungible with the broader money supply. And so essentially the Fed has a special code for the Treasury general account on their SQL ledger that says that if the government spends this money into the economy, it becomes bank deposits. It becomes M2.
Mm-hmm.
And so that's like the key distinction that everyone missed in 2008. Yes, the government did a ton of, or the Fed did a ton of QE. The government borrowed a lot of money. The government spent that on financial relief programs, meaning like bailing out banks and bailing out, buying MBS, buying credit default swaps. They didn't spend that as much as they should have on the real economy. And so that meant that the inflation that they created was isolated to the financial system. All this free money was circulating around the financial markets. And as they continued QE throughout the 2010s, stocks just started to lift off and haven't looked back, right? It's a parabolic move. But if you look at the actual inflation metrics, nothing occurred. Fast forward to 2020, 2021, now the government is in a situation where the demographics are worse. The debt is much, much worse. And now you have a crisis where the entire economy is locked down. It's the real economy that's really hurting, not the financial economy. You have to bail out, millions of people with these stimulus checks. They have to spend a bunch of money and the deficits blow out, right? And once those deficits start to blow out and the Fed's doing QE, the pairing of those two things now leads to those bank reserves, again, transferring through the financial system onto the Treasury's balance sheet. And then poof, poof, the magic of the Fed and their QE, those bank reserves become spendable money and the Treasury spends it, into the real economy. And all that cash just floods the system. And we see a massive wave of inflation. And so that's why everyone was caught unawares. The people who didn't understand this monetary plumbing, they were caught unawares because they just didn't realize that the equation for the, QE causing inflation has to have fiscal deficits included. If you don't have fiscal deficits, if the government's not running a big enough deficit or spending enough, it won't cause inflation. But as we go forward, right, and the deficits are getting worse in the US as well as in Canada and the rest of the world, the governments are getting into this debt black hole and they have to spend enough money to just keep the economy running. You're going to get in a situation where the inflation is just going to get worse and worse and worse. And that 2% target will become, an anachronism of the past. Will be in the rearview mirror. We'll be at 5-10%.
Yeah, and I think it was in the US, and I don't remember exactly who, but somebody was talking about the idea of like socializing that the inflation target probably should be 3 or even 4, without then considering the fact that even just at a 2% target, your money becomes 50% less valuable every 35 years.
Yeah.
So if you now bump that number to 4%, 17 years.
Yeah, it's insane, right? And that 2% figure, this is all theoretical. Like there's no actual basis or grounding for that 2% inflation figure. It's just, I think psychologically, it's small enough that most people will barely notice it. So if you just see prices go up 2% a year, it's not enough to really realize that you're being robbed over time. Yeah. It's that allegory of boiling a frog, right? If you throw a frog in boiling water, he'll wake up, he'll scream and jump out. If you put him in water and slowly bring it to a boil, he'll stay the entire time until he dies.
Yeah.
That's how it is.
Yeah, it's a really incredible phenomenon how they have done it really up until maybe just the last 10 years so slowly that, most of the people who are like 50, 70, 90 years old really went their entire lives without viewing it as a problem. Like it was for a long time, probably just gold bugs that saw this issue and everyone else sort of went about living their lives, watching the price of assets kind of slowly rise. And we were talking about this last night, the concept of, if you actually just look at the performance of stock index compared to the circulating money supply, they're all, it doesn't matter where you are, they're all essentially the same chart.
Yeah. Yeah. And especially since 2008. So in my presentation that I gave in Vancouver just, yesterday, I had a chart, or just 2 days ago, I had a chart with the S&P 500 divided by the Fed balance sheet. And I also did Nikkei divided by the BOJ balance sheet. And again, if you extricate this to every single central bank and every single economy, you see basically the same trend. You see fundamental growth in the ratio, which means basically like the Fed isn't easing or the BOJ isn't easing and the stock market goes up, right? So the ratio goes up and then you see a crash in the ratio when there's a crisis because they do some easing, right? And you see the ratio go up again, but this time the rate of increase is smaller during 2000 to 2008. And then it falls off a huge cliff, 2008. And then you see it flatline for 15 years. And that's happened across every developed market. And the reason why that flatlining matters is because what that implies is that the stock market is no longer growing independent of the Fed balance sheet, meaning the Fed balance sheet or the central bank balance sheet has to increase in order for the stock market to increase. And when the Fed balance sheet goes down and they taper, then the stock market falls. So the Fed has effectively financialized the stock market to the point where it's now a monetary medium, right? It only goes up and moves depending on the moves in the Fed balance sheet, depending on liquidity in the system. And that's problematic because that means that, the people who are getting wealthy now from stock market appreciation are only really profiting from Cantillon effects. They're not profiting from actual fundamental growth, right? Like I told you this question I posed to somebody in the spaces the other day is they said, oh, well, stock market's growing at 10% a year. And I'm like, yeah, don't you think that's a problem? The real economy is growing at 2%. And that's, 75% of that's government. So it's really like, a quarter of 1% real growth. And it's generating 10% of stock market growth. I'm like, that doesn't concern you. And you look at the graph of the US stock market in particular, it's a parabolic function. I'm like, we're not creating parabolic amounts of economic value right now. In the last 10 years, we haven't created exponentially more value every single year. What's happened in reality is that's just become monetized. The stock market's become monetized. The bond market's become monetized. And as we continue through this cycle of debt crisis, QE, monetization, liquidity wave, rally, crisis, QE, this cycle, the central bank becomes a bigger and bigger driver of markets until it's the only driver of markets. And this is when the Fed's mandate becomes inverted, right? Instead of becoming the lender of last resort, they become the lender of only resort. And when that key change happens, that's when you see inflation just go parabolic and the system finally start to reach this non-down phase.
Yeah. And so this is part of the problem. We've really even seen this over the last few months with the tariffs, where people don't want to see inflation, but they do want to see the value of their assets appreciate.
Yeah.
And so it's kind of like, you can't have both. Yeah. So if you want to see stock prices, home prices go up, you're going to see inflation and money printing, and the opposite will be true.
Yeah, exactly. You have to realize that recessions, this is the funny thing. It's like we become, no offense, but I think this is true of most people in the West, people become soft. They don't want to feel any pain. And that includes economic pain. Recessions are a natural and normal part of the business cycle. If there's an up, there must be a down, right? And if you look at the business cycle it's existed for thousands of years, there was, records of debt jubilees in the Old Testament. And even Sumerian texts talk about, every 49 years, there's a huge debt crisis in ancient Sumeria, and they have to rewrite all the debts and everyone goes bankrupt and they have to reset everything. And that's just the basis of, a monetary system that's especially based on credit. Is the credit will build up, there'll be a boom, a lot of speculation, assets will rise, and then once the debt builds up to a certain level and can't be paid anymore, people start defaulting, and then the whole system starts to roll over, a bunch of defaults, a bunch of liquidations, asset prices fall, and people feel the recessionary economic pain. And so in this vain attempt to kill the credit cycle that the Fed has embarked upon, they've destroyed the ability of the recession to be a valuable liquidator of bad economic energy, right? A badly allocated capital. The money that's been lent to, zombified companies that would normally be, that capital would be liquidated, and anyone who lent to those companies would be, lost, and those companies would go under. That's not allowed to happen anymore. The government isn't allowed to default on their debt, right? The major corporations aren't allowed to collapse. And by nature of that fact, it creates this economy that's increasingly zombified and completely dependent on low interest rates, infinite government liquidity, and infinite financing. And yeah, it's a huge problem. And you can't have both. You can't have real fundamental growth without understanding that there's going to be real fundamental pain occasionally, right? We'll still grow in the long run. There'll be the growth. It's a sine wave that moves up and to the right. That's the way to think of it. Like we're obviously going to grow because the population is growing and technology is advancing and technology is inherently deflationary, but there'll be temporary dips, 18 months, 2 years, 3 years of recessions. And that's natural. But the central bankers are intent on not letting that happen.
Okay, so now let's talk about Bitcoin.
Sure.
First time financial asset, universally available. form of sound money, instantly verifiable. How does it fit into this evolving interventionist system?
Sure. So again, if you look at the system, you look at how it's evolved, especially the last 15, 20 years, they've had to increasingly rely on liquidity injections and QE programs and bailouts to keep the engines on, keep the system running. And the side effect of this, obviously, like we mentioned earlier, is the massive inflationary wave. But the other side effect is that it's finally woken enough people up to the problem of fiat money that has created, not only obviously Bitcoin itself was created in the wake of 2008, but it's created more domestic, retail, and now institutional demand for a product that can't be debased. Because the problem with the fiat system, the problem with all debt systems, is that they're exponential. They rely on compound interest, right? Compound interest is the eighth wonder of the world. And when your money is lent into existence, which that's the way our monetary system works, all money is debt, right? That means that your monetary system and your debt system will grow in a parabolic function forever until they break. And every fiat currency, there's never been a fiat currency who's lived multiple hundreds of years or thousands of years without some form of debasement. And the average life of a fiat currency in general is 22 years, and the average life of reserve currency is 78 years until there's a hyperinflation or a debt default or a monetization. And so that means that, you're earning money in something that is, going to die on a hard stop at a certain point, like a remonetization, like what Peru has done actually with, they just swap out their currencies and say, oh, I want the old currency. It's no longer worth anything. Here's the new one. Or it's on the way to dying, right? You're either going to get your head chopped off or you're going to get bloodletted by 1,000 cuts via slow nominal inflation over time. Mm-hmm. So that means that now, the money you're earning is a melting ice cube and you need something, right? As the system reaches the parabolic phases of that exponential curve that we described of both the money supply and the debt growing exponentially, as it reaches that, you increasingly need something that will not debase, will not devalue. Mm-hmm. And that's where Bitcoin comes in. And the gold bugs are right in that they found a monetary asset, especially you're working on the 19th to 20th century models of something that can't be debased. But I think we're in the digital revolution now. We're well into the 21st century. We're not going to be going back to gold standard where we're shipping, a bunch of gold to another country on a sailing ship or a boat just to settle international trade. Like that's just completely unfeasible. And I don't want to settle a trade balance with you by bringing you a gold bar and flaking off 13 pieces and weighing it and then giving it to you. Like that's just impractical in the modern era. So Bitcoin is the one that can fill that role.
And so this is where I think it gets really interesting because all of the forces that you've been describing in the early part of this conversation, there are sort of multiple levels of game theory where nation states, individual actors have to act out of self-preservation. And there's also never really been a proper life raft to exit this system that is, like I said, it's inevitable. What will happen? What's unknown is when it will happen.
Yeah, exactly. And what you say about the game theory point is really good because let's go back to what I was talking about earlier with Triffin's dilemma and the global monetary system and all these other countries needing dollars, right? Triffin's dilemma only applies to a centrally issued currency because it deals with an issue with, here's the central entity, there's one node that emits the currency. And then there's 130 other nodes that are other countries that need the currency, right? So it's a centrally issued currency problem. Bitcoin obviates Triffin's dilemma completely because it's not a centrally issued system. It's a decentrally issued system. Whichever miner earns a block reward gets it. And they could be in China, they can be in Taiwan, they can be in Africa, they can be in Siberia, right? They can be in Norway, they can be wherever in the world and they can earn it. And so because it's decentrally issued, it obviates the complete need for Triffin's dilemma and it doesn't even apply, meaning it's actually the perfect reserve currency because anyone can earn it. It's just a matter of actually getting the mining up and having the electricity or the energy supply to do it. And so because of that, you could see this game theory quickly play out where nation states or central banks quickly start realizing, holy crap, I'm holding these long bonds, these US government bonds, they're down 50% in the last 3 years. My fiat is a melting ice cube. I no longer want to hold these, US dollar assets. I might still have temporary need for US dollar liquidity, like immediate fiat to spend and buy. But when I think about saving money, the treasury bond's not worth it. Stock market is just only keeping pace with inflation. It's not actually outperforming. here's a new asset that is completely, it's censorship resistant. It's inflation proof, obviously, because of the hard cap. It's basically anti-fragile because the more you try to attack it, the more you decentralize the mining in the nodes, ironically. So it's like this perfect example of, basically like a global reserve currency that can be used to settle trade or to deal with, settlement imbalances. And all these global nation states, if they, especially if some big ones like the US or China start buying Bitcoin in size, that could cause this, we could call it a global arms race to buy as much Bitcoin as possible and issue debt to buy Bitcoin and kind of drain the economic energy out of the fiat system into Bitcoin. And that kind of a move obviously would result in a very, very fast Bitcoin price appreciation. And it's all, again, dependent on what central bank moves fast, what the other central banks, how they respond. And central bankers in general are like the slowest to move. These are like the boomers. They're the most blue-pilled people on planet Earth. And so getting them on this, or getting nation states, governments who are already blue-pilled and slow to move and antiquated, it's a hard process. But I think once it starts, it will accelerate everything. And that game theory will just, especially once nation states start to get wealthy from this, they'll start clicking for everyone else. And they'll just domino effect Bitcoin, orange pill, every nation on earth.
We don't always talk a lot about price, but I think it is a really, for people trying to understand what this might mean for them.
Sure.
It is worth kind of having a think about how small Bitcoin is today and how huge these capital markets are and how much monetary energy there is to be absorbed. It's not, I think I'll talk about the idea of a $10 million Bitcoin, and people will often want to say that it's insane, and it might be, but it's not an impossible number.
No, it's not. It's truly not, because again, so let's look at just the raw data, right? Bitcoin right now, it's actually below $2 trillion market cap because we've had a correction here for the last few months. Bitcoin's like 1.6 trillion. The US government bond market is north of 35 trillion, right? The US corporate debt market is north of 50 trillion. The global debt market is somewhere around 400 trillion. And the global euro-dollar market is somewhere around 300 to 350 trillion. And no one really knows the exact side of the euro-dollar market, but it's huge. We're talking about a system where there's hundreds of trillions of dollars of wealth stored in global equities, global debt, in euro dollars, in derivatives, and all these instruments. And 1 or 2 trillion in total is allocated to Bitcoin in total. And again, and the other thing to even mention there is a lot of that Bitcoin is no longer even accessible, right? The 1 million that Satoshi holds hasn't moved in over a decade. They estimate that something like 10% of the supply is now frozen just because people have lost it in the wallet, forgot the password, the wallet got destroyed, whatever happened, that money's gone. And so you can effectively see that the actual supply is not 21 million, but more like 19 million maybe. And if that's the case, time's running out to get those remaining 19 million coins. And you could see a point where, sats themselves are worth multiple dollars, just a single sat. Which obviously that implies millions of dollars in Bitcoin price, tens of millions.
Yeah, it's going to be a really interesting thing to watch play out. And, I think about the market is trying to solve for this problem of preserving capital while the currencies themselves are devaluing. And it's like Bitcoin is really so elegantly designed to solve this problem without adding any extra bells or whistles. You don't need to, the fact that it's non-physical, there's some of these things that people would, outsiders would view as negatives. These are actually reasons why it's positioned to do the one thing that we need it to do.
Yeah. That's the irony, is that so you'll hear people, especially on Twitter or even LinkedIn, say, look, the problem with Bitcoin is that it's so slow, right? So it's so hard to change. It's this intangible thing that's extremely anachronistic, even by cryptocurrency standards, and cryptocurrency obviously is moving extremely rapidly. There's all these new technologies. There's ZK rollups, right? There's sharding from Ethereum. There's proof of stake. There's all these, brand new technologies. Bitcoin is slow and antiquated. It's running on 7 TPS, transactions per second. And who could actually believe that this thing could be global money? And I'm like, actually, that's exactly why it is. Ironically, you don't want your money to change every year. You don't want it to be able to, now we added the functionality to expand the supply. Now we added the functionality to freeze people's wallets remotely. Now we added a functionality to inflate people's individual wallets depending on what they spend it on. We don't want those things. That's leading down the route towards centralized money and CBDCs, right?
Mm-hmm.
And so what makes a perfect money is actually, ironically, the simplicity and the durability, right? With gold, for example.
Mm-hmm.
So gold, because Bitcoin kind of mimics the gold's mining characteristics as well as gold's permanence, right? Gold's unchanging nature. It creates the perfect monetary medium for a global monetary system. And all those things that people think are detractors say are negatives are actually the positives. Those are the strengths. You want a monetary system that's hard to change. You want a monetary system where the small blockers and the large blockers fight, and the small blockers who want to keep the system the same win.
Mm-hmm.
It's like to change the system, you have to essentially have something that's a universal good for everybody, not just for one interested party that has a lot of money or has a lot of power. It has to be a universal good. And the amount of things that are universal goods are actually pretty rare. A lot of things are good for a small group of people and bad for everybody else. That's how the government works, right? Specific grants, specific money, handouts, tax benefits to a select few at the cost of socializing the pain to everybody. And so Bitcoin is the first thing that comes in that solves that problem. The only way to change Bitcoin is to have a proposal that everyone likes, that benefits everybody, like SegWit, for example. And so the amount of proposals that get through that actually are approved are next to none, right? So the system doesn't change.
Mm-hmm.
That's a strength.
I almost feel like that might be a good place to break the conversation.
Sure.
Yeah. Is there anything else you want
to add, to talk about? Well, what I would say to everyone that's just like getting interested in Bitcoin is, just look up a graph of the U.S. money supply and the U.S. debt growth. And I have this in my presentation chart. If you model out the raw data from the U.S. government, from the U.S. Treasury, it's an exponential function. Same with the monetary supply. So if our monetary supply and our debt growth is exponential, that means that this problem of inflation, deflation, these cycles are going to get worse and worse and worse, right? 2008 cycle was worse than 2000. 2020 was much worse than 2008. The next cycle, in however many years that happens, when we have another crisis and they have to ease, it's going to be worse. They're going to have to print more money and the government's going to have to spend more money. And that just means that this inflationary issue, like the baseline of inflation, is going to keep rising and rising as we reach this, not beyond the nose, but dollar endgame, the subject of my book. As we reach the final stages of this dollar endgame, the currency starts to blow out, the inflation starts to blow out, and everyone starts to realize, holy crap, we're holding on to these melting ice cubes, and the rate of change is increasing, right? It's a positive second derivative function. It's going to exponentially get worse. And so whether you decide to buy Bitcoin today or tomorrow it actually matters a lot, because if you buy it tomorrow, Bitcoin price is going to be higher inevitably, because you're dividing a finite instrument by an infinite denominator. There's there's that saying that I think Jeff Booth says, or I forgot who says it in Bitcoin. He says, Bitcoin has no top because fiat has no bottom.
Mm-hmm.
That's exactly what I think about it. So I would say anyone who's interested and curious about, learning about this kind of a subject is look into the debt growth, look into monetary economics, look into how inflation and hyperinflations have happened in the past, and realize that all this stuff that we see around us right now, the monetary system, it's all temporary, right? It wasn't this way 100 years ago. If you go back a few hundred years before that, it wasn't that way. So the change is the norm. And so we're going to see a change in the monetary system in the next 10 to 20 years here. And if you're not on the right side with a good stack of Bitcoin, you're going to end up with almost nothing. And so I encourage everybody to look that stuff up and to obviously, do their research, do their work, stay humble and stack stats.
It's a great conversation. Thanks again for coming in.
Yeah.
Mentioned your book. You have a Substack and a YouTube channel, and maybe do you want to just plug
Sure.
where people can find you?
Sure. Yeah. So I do macro research online. I have a Twitter account called Peruvian_Bull. Also have a Nostra on there if you guys are familiar with that. That's in my extended bio. I have a Substack, like you mentioned, which is $endgame.substack.com. You can find that also in my bio. And I have a YouTube channel as well, where I post market commentary, interviews with experts, individual long form videos that are deep diving into subjects. All that stuff basically is all posted there. So if you guys are curious about learning more about macro, if you're curious learning more about the carry trade, trilemma, all this cool stuff, you can find me there and read some of my work there.
Cool.
Awesome. Thank you so much.
We will do this again. And if you're listening and you made it all the way to the end of the episode, thanks again for tuning in, and hope to see you next week.
Sweet. Thank you, guys.
Thanks for listening to this episode of The Block Reward. We're trying to do something different here, creating accessible conversations meant for people who aren't obsessed with Bitcoin. If you found this episode informative and engaging, hit that subscribe button to make sure you stay updated with future episodes. Your feedback matters. We'd greatly appreciate it if you could take a moment to share your reviews and help us with our goal of creating Bitcoin content that is simple and easy to understand. Bitcoin has an important role to play in the future of finance. It will change the way we save, spend, and invest. Discover why Bitcoin offers a game-changing opportunity for forward-thinking employers by visiting blockrewards.ca. Block Rewards' mission is helping Canadian employers implement strategies for integrating Bitcoin into compensation and benefits, supercharge your recruitment and retention strategies, and help your team members plan for the rising cost of living by rewarding their work with the hardest money ever invented. Special thanks to our top sponsor, Paramount Employee Benefits Consulting, Canada's only Bitcoin forward benefits and pension advisory. For more information, find them at paramountbenefits.ca. Big shout out to Podigy, our production team that makes all this possible, and BMX Escape for producing our music. Bitcoin is an expansive and dense topic many people walk away from early. To Bitcoin enthusiasts looking for that podcast they can share with friends, family, and colleagues, one they'll actually listen to, we hope that is us. The content of these conversations is meant to be provided for information purposes only. Nothing here is investment advice. Bitcoin is a big topic. Be sure to do your own research before making any personal financial decisions. Thanks for listening.